What do YouTube? In this video, I'm going to be going over how to avoid FOMO, or the fear of missing out. Let's get straight into the video. So this past Friday, January 20th, the market rallied about 1%, 1.5%. And one of the members in Discord DM'd me. He asked me, how do you avoid FOMO? Which brought some good questions in my mind. How do I really avoid FOMO and stuff like that, which made for a good video suggestion. The first thing I want to bring up is having a long-term portfolio. Now, why does having a long-term portfolio for me help me avoid FOMO? Well, let's get into it. Now, I think it's, in my opinion, personally, a lot easier to see FOMO, fear of missing out, in the stock market when things are going up. I'll pop up the chart of the whole emotional aspects of things. So people, when things go vertical, they start to get euphoria, stuff like that. That's when I think you see the most FOMO in the market, when the market goes up 4%, because naturally humans like to see things go up. They like to see their portfolio go up. They like to see their 401ks go up. Expanding off of that, this past Friday on the video, I had like 3 or 4, I think it was 3 call contracts, the 170s. I bought them. It was kind of chopping around sideways. I don't really feel like dealing with this, and I sold them for break even. Big mistake on my part. I looked at the contracts after the market closed. The contracts closed at $10. I bought them for about $3.80. If I would have just held all day, that would have been like a return of about $2,100. So it kind of hurt to look at. But now in the back of my head, I'm like, okay, well, yeah, it could be worse that I didn't hold these contracts the entire day. Going back to long-term investing, this is why it's so important to have a long-term portfolio. And in the past year, when NVIDIA's fallen 40, 50%, I think it's 60% from all-time highs to lows of 107. I've been dollar cost averaging down, getting my cost basis down. I have about 100 shares of NVIDIA right now. So every time NVIDIA goes up $1, I'm making $100 on the back end of that. So when NVIDIA goes up $8, $9 in one day, yeah, I didn't capitalize the whole move on the options, but my long-term portfolio, I think on Friday alone, it went up $1,000 just because of NVIDIA. Never really get the sense of missing out because I didn't capitalize off the move of options. I know because I have long-term stocks. I've lots of ETFs like VTI. Just because I didn't catch the move in my trading account, I know I caught that move in my long-term portfolio that will hopefully grow over the next 5, 10, 20 years. So that's the first way I try to avoid FOMO, just by always trying to keep in the back of my mind that I have my long-term portfolio working in the background. So if I didn't necessarily catch the move to the upside in my trading account, I know that all my stocks and all my equities I just know in the background that my long-term portfolio has been making money for me. So yeah, it sucks I didn't capitalize off options, but I was able to capitalize my long-term portfolio by just dollar cost averaging in every single day the market's open. Try to set myself up for the future. The second way to avoid FOMO for me would just be to avoid all the gap and go runner type stocks. Now, for me personally, I think it was like 2-3 years ago, back when I started trading common stock, I used to just sort by percent gainers for the day. I'd click on whatever stock was up the highest percent and try to trade it. So this led to massive amounts of FOMO. I'd see a stock up 250% in a single day. I try to go long in the stock. The next thing you know, the stock would gap down randomly for a volatility halt, FD approval type things, stuff like that. You never really know with these random movers and why they're moving. In my opinion, to avoid FOMO, I would just all around avoid these small and mid cap stocks that you really have no business trading. And there's no need to FOMO more often than not. Now, once I started focusing on mega cap names like Apple, NVIDIA, Tesla, Microsoft, Google, and especially like SPY and Qs, I noticed that the sense of FOMO kind of almost evaporated because I'm never really feeling like I'm missing the market because, like I mentioned in point number 1, if the market goes up, I'm already invested in the long term. So every time the market goes up, I'm making money off that. But when you see these random small and mid caps that aren't really correlated to the market and they're just going up randomly for no real reason, just a momentum type name, you're going to find yourself FOMOing into trades a lot more often than not. And that's going to lead to, losing lots of money, especially on these penny stocks when you can buy like 2,000 shares. It might not sound like a lot because you're like, oh, I can put $4,000 into it. I bought 2,000 shares for $2. But then when the stock gaps down, 50% in a halt and you have no choice to it, you just lost $2,000 and you can't even get out the trade because it got halted to the downside. Number 2 would just be to avoid small and mid cap names. In my opinion, just focus on the mega cap stocks where I think there's lots of opportunity every single day, and you don't have to worry about FOMO or chasing a stock to the upside or downside. And number 3 is there's always going to be a pullback. So I'm going to jump over to Thinkorswim for this just to show you guys an example of this on Friday. So now we're inside of Thinkorswim looking at NVIDIA. I actually had to go back a few days. We're looking at NVIDIA on January 17th, 2023. So in this example, NVIDIA opened around 168.27. We had this key level down here. And NVIDIA pretty much went vertical to start the day. It went from 169 all the way up to highs of 174. It didn't really see many pullbacks to get entry opportunities. Just by glancing at this, you may not know where to enter, where would you set your risk reward and stuff like that. So for beginners, like I mentioned, there's always going to be a pullback at some point. Very rarely will you ever see a stock have like 20, and this is the 1 minute, by the way. Very rarely will you see the stock have, an hour full of green candles all to the upside with no single pullbacks. It's pretty unlikely. Of course, there might be some anomaly, some short squeeze type, random penny stock going to the moon. But for normal equities like Nvidia, like I mentioned, the big six, Nvidia, Tesla, Apple, names like that, they're heavily weighted in the NASDAQ and S&P 500. You're never really going to see, 60 straight green candles in a row for an hour. There's always going to be some kind of red candle or a pullback to set up your risk reward, either to the upside or the downside. In this case, we're looking for an upside opportunity here on the video. If you guys haven't seen how to find key levels, you guys should go check out that video. It makes this a lot more easier because we already had these key levels marked in our chart. So looking at Nvidia right here, you saw that you had this key level marked in our chart at 171.76. So when Nvidia looked like this on the 1 minute time frame, you saw this candle starting to wick off 171.76. Now, to set up your risk reward better, you could have, instead of chasing this big one to the upside, in the case of the first 4 minutes, there's really nowhere you could have really set your risk off of when Nvidia went straight up. Let's just say you're on the 1 minute chart, you see Nvidia going vertical in the first minute of a market open. Where are you going to set your stop loss in this case? Now, especially if people don't wait for the candle to close, there's definitely been times you've seen candles look very bullish like this, and then 15 seconds before the candle closes, giant red seller comes in and pushes you all the way back down to 168. And then you're like, okay, I'm just down 30% just like that. Just because you weren't patient and waiting for the candle to close. So let's just say hypothetically, you wait for the candle to close. Based off key levels and stuff like that, your first take profit would have been up here at 171.76, or you could have said your take profit was up here at 172. Now in that case, where would your stop loss have to be realistically? Now, if you trade it based off levels and candlesticks and stuff like that, any normal person would say to invalidate their trade, you would have to stop out below the candle low right down here at 168.98. So let's just make this red to make this a bit more easier to see. So in this case, this is what your risk reward would look like. It's not very optimal, to be honest. If you copy this one up, it's pretty much like a 1-to-1 risk reward ratio, and that's not very ideal for any circumstance. Instead of chasing it mid candle, not around any key levels, let's just say you're a bit more patient. You wait for 171.76 to get retested for a break and retest to the upside, and then you go long with your target being 172.84. So let's just rearrange these things a bit more. So same target, you just made your risk reward a bit tighter. So you saw this retest coming in at 172.80 at 171.76, and this is your stop loss below the candle low at 171.45. So just by waiting for that retest, same profit target, same level we had up here at 172.84. You wait for a retest. You could also say a potential bull flag trying to form here. And look at the risk reward difference you made here just by waiting for a pullback. Now, it was a quick 1 minute pullback. It wasn't as clean as you would have liked. You can see the volume was kind of increasing here, which could have been a red flag. Of course, we're looking at this in hindsight. It's easier to look at in hindsight when you have all this information to you. But when you're backtesting strategy and seeing how things will work out in your favor, you want to try to take 2-to-1, 3-to-1, 4-to-1 risk reward trades versus setting your stop loss pretty far ways away and only getting like a 1-to-1 risk reward trade out of it. So you can see just by waiting for that slight pullback off this key level at 171.76, you set yourself up for a 3.5 hour trade. Your risk reward is below the low candle. Your profit target, same point. That's if you get a good entry off this key level. Or same profit target, different entry. You set yourself up by a 3.5 hour trade versus having that massive risk in the previous trade example. Now, like I mentioned, you guys already saw. Of course, this bull flag breaks out to the upside. You're already pretty profitable at this point, and then you can easily scale out. And what you do? Hit the key level perfectly off that break and retest the upside. You can easily scale out to the upside at 172.84, and you just had to set yourself up with a 3.5 hour trade just by waiting for that break and retest off that key level, because there's always going to be a pullback. So this video helped you. If you learned anything, just drop a like and comment below, and stay tuned for the next video. Thanks for watching.